Where do you position in these markets with this market sell down? Joining us now to help us navigate all of this market pressure. Very pleased to be able to welcome Thomas Hayes. He's the Chairman and Managing Member at Great Hill Capital. He joins us now from New York. I was trying to do a little bit of a pause there, Thomas, for effect, because you can't underscore the pressure that we have been seeing across these markets right now. So you're an investor, you're watching, you're asking yourself, I've seen up to 5% of losses if I'm just trading the index on the DAC today. What do you do?
Well, I think you have to put it in perspective, Will. We haven't even reversed the gains from last week. We're well off the lows from June. You know, the June lows were 36.36. We're at 39.32 on the S&P 500. So I think what you want to do is wait a day or so for the dust to settle and then selectively pounce. If you think about it in perspective, 0.1% month on month is 1.1% annualized. Whether that justifies a 4% to 5% collapse in assets in one day, I think is a good question here. But the good news is the peak narrative holds, as the June report was the highest inflation print. The bad news is the upside miss. It's really going to cement that third 75 basis point rate hike next week. And the key moving forward will be the guidance. Are we going 75, then 50 in November and 50 in December, or are we going 75, 50, and 25? And the market in our afternoon session in the United States got a little bit spooked because the Wall Street Journal threw out a trial balloon. Nick Timiraos put out the balloon. He's kind of the Fed whisperer about 100 basis point hike next week. And that's when you saw the market just tank. The expectations went up to a 47% chance in the futures market that might happen. And then they cooled off. By the end of the day, we're at 33. So we don't think that 100 basis points is in the cards next week. We think that the Fed has done a lot with the 75 basis points. And if you look at the components that really hurt today, they work on a lagged basis. You know, housing prices came down, but rents work on a lagged basis. Rents were still up. You know, used cars were down, but new cars were up. That's as the used car supply, as that supply comes on, we're going to see these things work on a lag basis, and new car prices will come down just like used car prices.
Now, I hope when you say wait a few days, because you run hedge, and I hope you're suggesting that people start maybe nibbling on Monday, because we've got that quad witch coming through on Friday that could be relatively terrible when it does come to positioning. But just in terms of where to position, I want to play a little bit of a chat that we had with Andrew Slimman, because one of your picks is also one of his picks. So I just wanted to play a little bit, and then we'll talk about it.
Okay. And if the Fed brings down inflation, I think rates will come down. If the Fed over tightens and we go into a slowdown, I think rates will come down. And either or is actually good for home builders down at these levels, because yes, housing starts will slow, but mortgage rates will start to come in. So I think we're towards the end of where the 10-year is moving to. And that's why I think these early cycle stocks I find intriguing, because they're down so much.
And the stock he was talking about, Tom, was Lennar. Do you share that view that that's going to be the driver? Because there are a lot of people on the sell side that are suggesting you can't be investing so much in these home builders. Now, Lennar's probably printing at around about 74, 75, PT of around about 88, but there is potential downside if we see rates continue to surge higher.
Yeah, well, the good news is we come to the same conclusion, but we don't have to predict it. What we're seeing right now in the commitments of traders report for U.S. Treasuries, the 10-year note, is that commercial hedgers are the longest that they have been on Treasuries since 2018 bottom, 2014 bottom, 2011 bottom, and 2009 bottom. So we don't have to buy Lennar right away, and we don't own it yet. But the minute we do see a bid in the 10-year Treasury and we start to see yields compress, which may come a lot faster than people are expecting. I know after today it looks like the exact opposite is going to happen, but that's usually when you have these type of inflection points, when the large traders are all on one side of the boat and there are no buyers left. You want to follow the smart money with the commercials. So with Lennar, it's kind of a no-brainer. Once you see those rates start to move, once you see a bid in Treasuries, that's going to be the leverage play to play the stabilization in rates, because you've got 72 million millennials in the United States, average age 31, and what they need is starter homes. Even with higher rates, 6% 30-year mortgage, if you can get that starter home price down to 300, 350, Many of those people can afford it. There's a large transfer of wealth from the baby boomers also to the millennials. And we have a 3.8 million unit undersupply. So who's going to provide those is the home builders like Lennar, like Pulte, like KB Homes, and they're trading at 5 times next year's earnings. So we think that is a great play. We are not in it yet. We're going to, rather than predict it, we're going to wait for rates to tell us when it's time to start to get in. Sentiment is negative. It's not negative enough, but we think that may come to bear in the next few weeks, and certainly as we go into the cooler season.
So it kind of sounds like you're in the camp that we are going to see those rates compressing on the 10-year by maybe December, maybe November. But I'll leave that there because I've got to get to Baba, because you love Baba, and we're hearing a lot of chatter. You heard Emily just talking before about that pressure that they are seeing yet again today. Obviously, the whole basket of the China-listed stocks, the Crane shares ETF, anything that's involved in China tech is obviously going to see the pressure to the downside because of what we saw on the NASDAQ. But the question I'd have to you, because I know that you think Baba's cheap, but how do you price the potential that after these midterms we're coming into a cycle in the United States where there could be even further aggression directed towards China and anything China related, and how that will impact capital flow out of potentially these China tech stocks?
Well, there's certainly capital flow issues, but when you look at the business, they have a lot of catalysts coming up. Number one is the audits are happening in the next couple of weeks. The U.S. regulators are going over to Hong Kong for the PCAOB, so that's a catalyst. Number two, you've got about $100 billion of current assets, $73 billion of cash, about a little more than a third of the market cap in basically cash they could buy in their stock. Everyone continues to forget that they still own a third of the largest financial services company in Ant Financial. When or how that will ever go public is immaterial. The key is the business will continue to grow over time. It's simply cheap. And then you've got the whole cloud business. And McKinsey put out a report last week. The cloud is going to triple in China. The digitization is 5 years behind the US. Alibaba has 36% share of that market. You know, that could be $20, $30 billion that's accretive right to the bottom line. That's not priced into the stock. So at the end of the day, you're talking about a $400 billion, $500 billion stock before you even get into the e-commerce business. And because sentiment is so compressed, no one can see it right now. But I'll tell you the trigger. Like I told you, the trigger for the home builders, the big trigger, if you're not in Alibaba yet, the big trigger is going to be watch the US dollar. And just like we have commercials, if you look at the Commitments of Traders report, the longest that they've been treasuries before the bottoms, we have commercials the shortest that they've been the US dollars since the tops in 2020, 2017, 2015, 2013, 2009, and 2006. So you can bet against the commercials being wrong. It would be the first time in the last 20 years and say the dollar is going to go up forever. But the second you see that dollar stabilize and start to come down, which again, you know, today looks like the exact opposite, but take the pain trade. Look a month to 3 months out. These contrarian trades are where outperformance comes over the long term. The minute you see that dollar start to stabilize, we started to get a taste of it last week, then we got reversed today. That's when money's going to start to flow into emerging markets, and the weight of China, 33%, and then the weight of Alibaba is one of the top few weights. It's an absolute home run.
So bye, Baba. Tom, we're going to have to leave it there, but thanks so much as always. Speak to you soon. That's Tom Hayes of Great Hill Capital. Street Signs back in 2.